Everybody, again with foreign currency transactions, we will continue the discussion of the last learning objective of this chapter, accounting treatment given various types of foreign currency hedge. In this video, we will discuss how we record the appropriate transaction where we have cash flow hedge. Let us see this example. Utility anticipates purchasing oil for sale to its customer. Anticipates purchasing oil for sale to its customer. Still we didn't sell, still we don't have the inventory, but we forecasted that we will sell to our customer next February. Okay, for that we entered into future contract to protect ourselves against what? Against forecasted transaction. For that we will recognize any difference because of entering into this kind of future contract by recognizing the difference as other comprehensive income. Here on December 1st, utility enters, our company enters into future contract to acquire 4,200 gallons of oil at 1.4007 per gallon for delivery on January 31. We are talking about 2 months, December, and will be settled on will be delivered on January 31. A margin of $10 is to be paid up front. We paid in advance to enter into this contract $10 as a future contract, so we will recognize it or record it as asset. On December 30, at the end of the period, the price for delivery of oil on January 31 is 1.4050. The point is here, we entered into forward contract to protect ourselves against the increasing the prices. We entered into forward contract to acquire the gallon by 1.4007, where the price is increased to 1.4050. So in this case, we are talking about gain at the end of the current period. On January 31, the spot rate for current delivery is 1.39. We agreed to buy it by 140 and we adjusted it on the date of preparing the financial statement to be 1.40. At the on the settlement date, prices were declined to 1.39. So in this case, it means we are talking about loss. Utility settlement, the contract accepting delivery of settlement, the contract on the date of settlement, and accepting delivery of 4,200 gallons of oil. Also, they purchase it. In February, utility sells all the oil to its customer for 8,400 and reclassifies its other comprehensive income from the hedge as cost of sales pertinent rates. Here, we are talking about more than one transaction. We forecasted that we will sell. To protect ourselves and to satisfy our customer, we entered into forward contract to protect ourselves against what? The fluctuation of the prices of oil. We entered into forward contract to acquire 4,200 gallons by 1.4007. The cost of oil gallons in total equal 1.4007 multiplied by 4,200, the acquire quantities. So in total, we are talking about, we intended to pay 5,882.94. At the end of the period, on the date of preparing the financial statement, the prices increased to 1.4050. So it means if we intended to acquire this quantity on 31 December, the value of it is 5,901. As we entered into forward contract by 5,882, it means that the value of the contract that we entered to has been increased by the difference. The difference is or change in future contract equal $18.06. So on the date of preparing the financial statement, here we have gain. Let us see how we will record the $10 that we have paid, margin of $10 is be paid, and how we will record the difference. Then we will move on to record the transaction on 31 January. On 1st December, we signed the contract and we paid upfront $10. So we will record it. Future contract as asset, $10 debited by $10, and cash credited by $10 as the cash declined. So it's credited where the asset is declined, so it will be credited. On 31 December, the value of the contract has been increased because the price has been increased from 1.40 to 1.4050. So we have gained by $18.06. We will record this amount of gain. Future contract is debited by the exchange or the difference, and other comprehensive income will be credited as we have gained. And we are talking about here about cash flow hedge, so we will recognize the amount of gain or loss by other comprehensive income because we don't have recognized the transaction. Okay? Let us move to see what happened on 31 January, the settlement date. The prices has been declined from 1.4050 to 1.3995. So here we are talking about the value of gallons equal 5,877, and already we have adjusted it on the date of preparing the financial statement by 5,901. So here we are talking about declining the value of acquired gallon or intent to acquire gallon. So here we are talking about loss by 5,901 to 5,877.9. Here we are talking about $23.1. So we have to record it. Other comprehensive income will be debited as loss by 23.1, and the future contract will be credited by the value of it will be credited by 23.10 or 23.1. So here in total we are talking about the future contract debited by 28 and credited by 23. So here we are talking about the difference of 5.04, the difference between the loss on this difference occur loss on contract as the value of gallons, acquired gallons, has been declined from 140 to 139.95. On the settlement date on 31, here the point is we have settled, as he mentioned here, utility settles the contract accepting delivery of 4,240. How we will settle it? By the difference. Here we are talking about 4.96. We will receive it as the value of it were debited by 28 and credited by 23. So here we are talking about the difference of 4.96. The difference from 5,877.9. This is the value on the date of settlement, the value of acquired goods, and on the date of agreement 5,882.94. So here we are talking about 496. So we will receive this amount as the value has been increased from this amount to this amount. So we will receive in cash to settle it, to settle the future contract. Instead of sell and receive and pay, we settle it by the difference. We will receive 4.96 to settle the future contract. Here, after we recorded this entry, the future contract balance will be 0. But as he mentioned, we accepting the delivery. So the value of delivered goods equal on the date of settlement 5,877 will be debited, and cash we will pay the cost of this inventory that we received by 5,877.9. Okay, but be careful here. On the other hand, we have loss. We have to adjust it when we sell the inventory as the inventory associated with the forward contract. Here, as he mentioned, in February 20, sells all the oil to its customer for 8,400. So we will receive this amount. 8,400 will be received as we sold it, and cost of sales will be debited by 5,877, and inventory also will be credited by 5,877. On the other hand, we will continue to debit the cost of sales, cost of goods sold by $5.04. This is the amount of loss that occurred during the acquiring the future contract. Here you can calculate it. Other comprehensive income credited by 18, but here debited by 23.10. So we are talking about loss of 5.04. So we will adjust it as we sold the inventory, and this amount of loss or gain associated with this acquired inventory as we entered into forward contracts. So the cost of sales will be increased, will be debited by 4.04. Until now, it's enough. By this point, we have finished the discussion of this chapter. Let us move to the coming chapters or coming chapter. See you there.